Okay, let's unpack this. We are jumping into the high-octane world of stock market super performance, but we aren't talking theory today.
No, no.
We are talking pure, hard mechanics delivered by people who have actually turned, five-figure accounts into eight figures. This deep dive is built entirely on a collection of sources centered on the book Momentum Masters.
And it's a remarkable resource, precisely because it was born out of genuine trading problems. The origin of Momentum Masters is actually critical to understanding its focus.
All right.
Mark Minervini's 2013 bestseller, Trade Like a Stock Market Wizard. It didn't just sell copies. It generated nearly 1,000 questions from readers.
1,000. Wow.
Yeah, and these weren't like philosophical or academic questions. They were practical, real-world trading challenges. The kind of, knowledge gaps that separate the consistently profitable from everyone else.
I love that origin story. So instead of just sitting down and writing a second book of advice, Minervini knew these questions needed nuance.
Exactly. So he decided on this really unique roundtable format.
He brought in 3 other legendary traders, right? Each with an astounding verified track record.
Yeah.
All to provide these comparative perspectives on the exact same problems.
That's it. And the book, it deliberately avoids any biographical fluff or, generalized market commentary. It's just a focused, high-density knowledge transfer dealing purely with the mechanics of high-performance trading.
So our mission today is to cut right to the core of this collective expertise. We're going to try and extract the most critical insights from the first 4 sections, which really form the bedrock of their systems.
Right. We're talking core philosophy, stock selection, position sizing, and of course, technical analysis. For anyone listening, these sections explain not just what they trade, but crucially, how they manage the capital risk that's inherent in these aggressive momentum strategies.
And here's where it gets really interesting. The sheer scale of success achieved by these 4 individuals, the momentum masters. I mean, their track records, they don't just demonstrate success.
No, it's exponential growth.
Yeah.
And crucially, these numbers are independently verified.
Okay, let's get into the numbers because they are, frankly, staggering.
They are. Let's start with the architect of the book, Mark Minervini. Starting with only a few $1,000s, he averaged an astounding 220% per year for 5 consecutive years. This is back in the 90s.
220% a year.
A year for 5 years straight. If you crunch that compounding math, it translates to an incredible 36,000% total return.
That's the difference between starting with, say, 100 grand and ending up with over 30 million just 5 years later.
That's the power of it. And he cemented this by winning the 1997 U.S. Investing Championship with a 155% return.
And just think about the psychological weight of those returns. You're not just making 20% a year. You are literally multiplying your money over and over. Then you have David Ryan.
A true champion. And a protege of the legendary William O'Neill.
That's right. Ryan is a 3-time U.S. Investing Championship winner. He took the title 3 years in a row from 85 to 87.
His total return over those 3 years was 1,379%. It's just a demonstration of relentless high-level consistency. It proves his method worked across different market cycles.
Absolutely. Then next up is Dan Zanger.
Zanger's story, it really defines the power of chart analysis. After 25 years of intense study, he famously turned, get this, 10,775 into $18 million.
In 18 months, during the tech boom.
18 months. It's a mind-boggling 164,000% return. He's often recognized for his exceptional technical analysis, and he primarily focuses on larger cap stocks, which is an interesting contrast we'll get into.
And rounding out the group, we have the new generation master, Mark Ritchie II. He really proved the system is still viable today.
He did. He won Minervini's triple-digit challenge back in 2010. He achieved a 100% return in less than 6 months. And since 2010, his total return has exceeded 1,000%.
So what's fascinating here, and what we're going to explore, is that while they all share these core principles, the fundamentals of how markets move based on supply and demand,
their specific tactical applications and their preferences, they offer these really rich contrasts.
Like you said, Minervini favoring small caps versus Zanger preferring large caps.
Exactly. And this allows you, the learner, to see multiple successful pathways built on the exact same rock-solid momentum rules.
Let's jump straight into their philosophy then, starting with this idea of evolution versus consistency. When you look at decades of trading experience, you'd almost expect massive shifts, but the masters emphasize something fundamentally different.
They do. They talk about timelessness. Minervini and Zanger both highlight what they call the 95% consistency. Minervini states his core approach is 95% unchanged after decades.
Why?
Because the law of supply and demand, the basic human impulse of greed and fear, it's constant. Zanger echoes this. He notes that the classic chart patterns they use were evident in markets 100 years ago and will likely be the same 100 years from now. The machinery gets faster, but the psychology is static.
Okay, so if the foundation is 95% consistent, what makes up that other 5%? Because, I mean, a 5% shift in a system that gets you 200% returns it's monumental.
It is. And the refinements, they really center around adapting to modern market behavior and volatility. For instance, Minervini and Ryan, both veterans, they point to specifically adding pullback setups to their repertoire.
So they weren't just buying breakouts anymore.
Right. They started out focused only on that initial breakout, but the market structure has evolved. Now, institutions are quicker to shake everyone out, meaning a lot of quality stocks will break out, pull back to test that pivot point, and then move higher. So they adapted to capitalize on that safer reentry.
That nuance moving from always buying the breakout to sometimes buying that subsequent low-risk pullback, that's a huge tactical lesson. It requires patience, which has to be hard when momentum is your focus.
It is. And Ritchie II introduces an even more sophisticated layer. He talks about technical themes changing within market periods.
A technical theme. Let's unpack that. What does he mean?
So a technical theme isn't about the strategy changing, but the optimal setup changing. For instance, he noted that in a recent period, buying brand new 52-week or all-time high breakouts was really difficult because they'd immediately fail.
Ah, okay.
So the prevailing theme had shifted toward stocks that were already in an uptrend, but were coming off a constructive pullback rather than those pristine new high breakouts. It's this constant micro adjustment to what the market is giving you right now.
It just highlights that even after achieving massive success, the commitment to refining your skills never, ever stops.
Zanger illustrates this perfectly. He points out that he's far better at cashing out of stocks before a market breaks than he was even 5 years ago. The learning curve is infinite.
This theme of discipline, it leads directly into their daily routines. And there's a massive shared takeaway here for any trader listening.
The universal prioritization of advanced preparation. Doing all the hard analytical work outside of market hours to completely remove emotion from your decision-making during the trading day.
This is the single most consistent piece of advice from all four of them. Minervini and Ritchie II both say explicitly that they know exactly what they're interested in buying, at what price, and where their stop loss is going to be before the market even opens.
It completely transforms the trading day, the chaotic market hours. They stop being a decision-making session, and they just become a simple execution window.
Right.
Minervini gives great detail on his morning routine. His work is done the night before, screening charts, setting his pivots. He gets to his screen at 8:30 a.m. ET, reviews any overnight news, updates his stops, and sets audio alerts on both his buy candidates and his sell stops. It's a structured, almost defensive routine to make sure no sudden move catches him unprepared.
It's amazing to think about his dedication, too.
Yeah.
He throws in that historical note that he used to plot charts by hand 30 years ago, before computers. That wasn't just analysis, that was physical labor.
Exactly. It tells you that the dedication to foundational technical analysis is just non-negotiable. That manual plotting forced him to look at every single bar and every volume spike with extreme focus, something that I think is often lost in the age of instant digital charts.
Meanwhile, you have Ryan on the West Coast. His routine starts with reading the Bible for perspective, then he dives into the news and alerts. But crucially, he avoids the first 45 minutes of trading entirely. Why that pause?
That pause is pure risk management. The first 45 minutes are notorious for false moves and noise. It's the market digesting all the overnight news, futures action, analyst upgrades, downgrades.
The churn.
He calls it churn, exactly. By waiting, he avoids getting sucked into it, preserving his capital for cleaner setups later in the day.
I love how Ritchie II frames his routine. He calls it watching a game film before the game. He reviews his potential targets so thoroughly that the speed of the market action actually slows down in his mind,
which allows him to react instantly and without hesitation. He dedicates about 2 hours before the open and 2 after the close to deep analysis, screening, and meticulously logging all his trades.
And then Zanger's routine, it gives us this really interesting look at real-time confirmation. He watches the pre-market tape, he checks futures, and he uses this proprietary Sounds of the Market program
that he developed himself like 15 years ago
to literally hear which stocks are popping on the bid or the ask.
And his core focus at the open is on volume confirmation during early gaps. Heavy volume suggests an extension of that morning move, whereas light volume on a gap suggests a reversal, or a buying opportunity, a key low-risk entry.
So moving from personal routines to market structure, we have to tackle the elephant in the room, high-frequency trading. And what's remarkable in the book is the unified condemnation from the veterans.
The critique is strong. I mean, even inflammatory. Minervini calls HFT absurd, a loophole that allows front-running. He calls for serious regulatory action.
And Ryan agrees.
Ryan agrees, calling it illegal front-running that causes excessive noise and false moves. He even suggests bringing back market specialists and the uptick rule to create a more orderly, human-driven market.
Okay, wait a minute. If Minervini and Ryan are calling it illegal front-running and are clearly outraged by it, how do we square that with Zanger saying HFT noise is largely irrelevant to its core strategy? Isn't that a massive contradiction?
That is the essential contradiction.
Yeah.
And it all comes down to their time horizons. Zanger acknowledges HFT's presence, especially since decimals came in around 2001. He notes it's designed to shake us out. But he offers two ways to adapt.
Okay.
First, you can use faster time frames, like 3 or 5 minute charts, and you buy the intraday weakness. You essentially fight fire with speed.
And the second way?
The second, the one that's more effective for Zanger, is to end run the whole HFT quagmire. You do that by focusing on high-quality setups, buying breakouts from solid bases, and holding for months. In a multi-month trade, the microsecond noise from HFT programs is, as he says, largely irrelevant. The noise only really matters if you're focused on those tiny intraday moves.
So the answer to HFT is either fight it on a faster time frame or elevate your trading to a longer one where the initial noise just dissipates. That's a practical solution, even if they still hate the practice.
And Ritchie II, the younger trader, he adds very insightful structural critique. He argues that the entire debate is hampered because HFT has never been adequately defined by regulators or even practitioners. He says many people are opposing something they can't even accurately describe.
What's he talking about specifically? Unethical but legal practices.
Exactly. He points out behaviors that mimic prohibited actions from the old trading floors. For example, the practice of jamming huge sizes onto the offer or the bid price and then just stepping out when someone accepts it.
Which creates false liquidity.
Temporary false liquidity. It influences price discovery and often leads to terrible fills for traditional traders. It undermines the very spirit of a fair price discovery mechanism.
Let's pivot now to the mindset. Why did these guys commit to something that requires such intense preparation and discipline?
Well, Minervini's initial attraction was pretty stark. He grew up poor and he wanted to get rich.
Simple enough.
That was the lure, but it was quickly replaced by something else. He found that the challenge, the art of speculation itself, became the greater motivation. Money just became a way to keep score.
For Ryan, it was more of an intellectual pursuit, right? A treasure hunt.
A treasure hunt for super-performing stocks. But the journey was far from smooth. All the masters, they emphasize early, significant struggles, the necessity of failure.
This is often the biggest mental hurdle for new traders, isn't it? The inability to accept being wrong, to accept losses.
Look at Minervini's path. He produced terrible results for about 6 years, despite intense study. The turning point was a severe ego check, a moment where he just decided, the heck with my ego. The goal is to make money, not be right.
That distinction, the goal is to make money, not be right. That is the ultimate psychological hurdle for most people.
It is. Only after he consciously learned to admit his mistakes, cut losses without hesitation, and protect the small profits he made, did the consistency and then the massive performance finally come together.
And Ryan followed a similar painful path.
He did. He doubled an account right out of college, which gave him this false confidence, and then he immediately lost it all and then some. It took him over 2 years to become consistently profitable. And that only came after he systematically studied all his mistakes and adopted extreme, almost rigid discipline.
Zanger's story is probably the most dramatic illustration of failure leading to a complete philosophical overhaul.
Oh, absolutely. He saw initial success turned $100,000 into $440,000, only to lose half of it in a correction. He then spent 6 frustrating years just trying to recover those losses.
And that desperation, it peaked during the October 1997 market break.
It did. He ended up broke and actually owing his broker $225, a symbolic low point where the market didn't just take his capital, it put him into debt.
Owing his broker money. That is a physical, undeniable manifestation of failure. What happened next?
He sold a car to restart with $10,775. And that intense 6-year string of failures led to a powerful oath. He swore he would never let a belief, a story, or a rumor blind him again. His rule became absolute. If a stock gets very shaky for even a single day, I'm out.
Wow.
And that forced him to ignore all the external noise, all the stories and rumors and news, and focus purely on price and volume, the only undeniable truth. And that shift paved the way for his 164,000% run.
Given all this talk about HFT and powerful institutions, the question that always comes up is the game rigged?
Minervini is absolutely adamant. The game is not rigged, and those who claim it are simply making excuses for their underperformance.
He has a huge argument for the small investor, doesn't he?
He does. The famous analogy with a large institution driving a cruise ship and the small trader in a speedboat. The small investor can enter and exit trades instantly, whereas a large fund might take days to build or liquidate a massive position, which inevitably moves the price against them. He says the market is absolutely beatable if you commit to the work.
But that size knife, it cuts both ways, right? Zanger points out that big players definitely use their media power and hype to shake out the little guy.
That's true, they do. Big funds have access to superior information. But Ryan counters that their sheer capital size makes them inherently less maneuverable. They're slower to change course. So the individual trader who can spot institutional accumulation early can move faster and capitalize on that initial momentum before the fund can even finish building its position.
A quick note on practicality then. What about trading with a full-time job?
Minervini says it's possible, but it's inherently more difficult. You have to rely almost totally on mechanical stops you set the night before.
But Ritchie II is a little more skeptical.
He is. He believes achieving sustained, market-beating returns over time is extremely difficult with a full-time job. He suggests that only long-term horizon stock picking, not aggressive momentum trading, is truly feasible in that scenario. Super performance requires super focus.
Okay, so that discipline sets the table. But now let's talk about the main dish. If these guys are aiming for 200%, 300% annual returns, their stock selection criteria can't just be good.
No, they have to be razor sharp. And the first non-negotiable requirement is relative strength, RS. This is the absolute core of the momentum philosophy.
For those unfamiliar, relative strength here doesn't mean the RSI indicator, right?
Correct. It means the stock's performance relative to the overall market or its sector. It's the easiest way to identify leadership. A stock with high relative strength is outperforming the majority of other stocks, which demonstrates strong institutional demand, even if the overall market is soft.
And this foundation leads to an absolute consensus rule that protects their capital.
Avoiding falling knives, yes. They never bottom fish. They never try to catch a stock that's in a free fall.
It's such a common mistake for amateur traders thinking they're getting a bargain.
It is. And Minervini says it just leads to losses because you're fighting the dominant trend, which is distribution. He'll only buy a stock coming up off a normal pullback if it is already in a strong, established uptrend and moving through a pivot point.
So even a pullback buy is still executed within the context of established strength.
Always. And Zanger drives this home with his own record. 95% of his massive profits were made in stocks hitting new highs from very solid bases. The psychological hurdle of buying a stock that is already high is exactly what separates them from the masses.
Ritchie II is just as strict.
Equally strict. He says he'll only scalp futures in bottom fishing scenarios with extremely tight stops, but never in his core momentum stock trades. The principle is clear. Buy strong, avoid weak, and never try to predict a bottom.
Now, many new traders fear thinly traded stocks, assuming that lack of liquidity means excessive risk. But Minervini flips that script. He encourages traders to embrace them.
He does, because he sees them as the source of the biggest, fastest winners. Small, unknown companies are less efficiently priced than large caps. And when institutional interest finally lands on them, they can move dramatically. He'll trade stocks with 100,000 to 300,000 shares per day, sometimes as low as 50,000.
50,000 shares a day. That sounds incredibly risky if you have millions in capital. How do you manage that liquidity risk?
And that's the critical caveat. Your position size must be adjusted to ensure a safe exit. If you take a 25% position in a small cap, you have to be confident that your trade size won't crash the price against you as you try to get out. You have to be able to exit cleanly.
Ritchie II is a bit more conservative, but still looks low. He generally avoids names under 25,000 shares a day.
Right, which just reinforces that while massive volume isn't always necessary for entry, the ability to execute the exit safely dictates your capital allocation.
And what about modern complexities like dark pools?
Minervini is completely unfazed by them. He focuses on the end-of-day volume tally. That final number includes all the dark pool activity and tells the true, undeniable story of accumulation or distribution, so he doesn't have to worry about intraday extrapolations.
Let's talk price cutoff. Does a stock have to be cheap to have super performance potential?
Not at all. Minervini doesn't avoid high-priced stocks. In fact, he notes they often carry better fundamentals and can be less volatile. Ritchie II will buy low-priced stocks, but only if they are very liquid and in the top 2–3% of relative strength, and he takes smaller positions because of the higher volatility risk.
And finding the leading groups? Is their approach top-down, starting with the sector, or bottom-up?
Minervini and Ritchie II both use a staunchly bottom-up approach. They let the best-performing individual stocks lead them to the best industry groups. The key is spotting that individual strength, that leader, even when the overall market or its group is weak.
That's a huge philosophical shift from typical macro analysis. The strength of the stock itself dictates the whole thesis. What about small caps versus large caps?
And this is where we see that key stylistic contrast. Minervini explicitly prefers small caps near new highs because they're less efficiently priced. He thinks large cap action is often more random or crowded.
But wait, Zanger, the master of the 164,000% return, specifically prefers larger cap and mega cap stocks. Why the difference?
It comes down to liquidity and time frame. Zanger needs the liquidity for his massive capital allocations, and he finds that the longer-term moves in mega caps can sometimes ignore the HFT noise that Minervini has to deal with in smaller names. For the listener, this is powerful. Both paths work as long as the core principles are applied.
And what about IPOs? Inherently risky, no history.
Minervini waits at least 3 to 4 weeks for some trading history to establish, and when he does look at them, he applies the same strict criteria, a sound base emerging from consolidation near the all-time high. The only difference is recognizing that the time frames for base building are compressed.
If stock selection is finding the engine, then position sizing is the absolute core of risk management. For you, the learner, this is probably the most critical section.
It is the math behind the madness. Section 3 immediately tackles the concentration versus diversification debate. And Minervini and Ryan strongly agree. If you have a significant proven statistical edge, wide diversification dilutes your performance.
So you can't get 200% returns spreading your money across 50 different stocks.
You just can't.
Minervini is precise about his targets. He aims to put up to 25% of his portfolio in his best positions. That's a massive commitment to a single idea. How does he justify that?
He justifies it mathematically. He mentions this is derived from something called optimal F, which is a variation of the Kelly formula.
Okay, let's explain that. The Kelly criterion.
It's a mathematical formula used to determine the optimal size of a series of bets to maximize your long-term compounded growth rate, given that you have a known probability of winning your edge and a known risk-reward ratio.
So he's not just guessing 25%. It's a formula that says, with my 2-to-1 edge, this is the maximum I can safely bet to maximize my long-term compounding.
Exactly. But we have to stress, this is all predicated on a proven multi-year statistical edge. If you don't have that edge, putting 25% in one stock is financial suicide, not super performance.
Right. Ryan is a little less aggressive, initiating at 10% position, so 10 stocks max.
And he'll only increase that size if the stock moves well, builds a new base, and then breaks out again.
Zanger, meanwhile, is the most flexible, holding anywhere from 8 to 25 stocks.
All depending on market conditions and the number of great moving sectors available. It just shows that adaptability is key.
But this concentration, it mandates strict risk limits. This is the non-negotiable insurance policy.
It is.
And their risk tolerance is shockingly low compared to their concentration. Ryan risks a maximum of 1% of total equity per trade. Break that down for us.
Okay, so for an initial 10% position, he calculates his stop loss so that if the stock hits that stop, the resulting capital loss is only 1% of his entire account.
So if his position is 10% of his account, that means his max loss on that stock is 8% of the position itself, right?
Yeah.
10% position, 8% loss equals 0.8% loss.
Correct. And he typically cuts losses even before that 8% limit is reached. It's extreme discipline. Minervini's risk is a little higher, usually between 1.25% and 2.50% of total equity. His 25% position with a 5% stop equals a 1.25% capital risk.
And Ritchie II starts even tighter.
About 50 basis points, so 0.5% of risk on a starting position. Then he scales up from there. It highlights the foundational rule. You define your potential loss before you define your potential gain. The focus is always on capital preservation.
Let's talk scaling. Minervini's max is generally 25% on entry, but he's gone as high as 50% in names after a profit has been established.
This is capital compounding at its most aggressive. Yeah. He's building into a larger position only as the trade is already generating profits for him. And he says he has never put his entire account in one stock.
What about minimum size? What do they do in tough markets?
Zanger offers a really counterintuitive insight here. In a tough, choppy market, he trades as low as 1% in positions. Not because he expects a huge win, but just to stay in tune with the market.
Why is staying in tune worth risking 1%?
He argues that being completely on the sidelines for long periods causes you to lose your feel for the tape. By keeping a small hand in the market, you maintain your tuning, so that when the pivot happens and conditions improve, you're ready to hit the ground running. You avoid being too tentative when the big move starts.
That makes sense. And Ryan also starts smaller, 5% positions, when the market isn't in a solid uptrend. What about adjusting size based on account growth?
The rules here reveal a lot of caution, even during success. Minervini uses his whole growing account, but he advises new traders to hold off on aggressively increasing position size until the account is already up 25% or 50%. Create an equity buffer first.
Zanger, however, tries not to increase trade size as the year goes on. That is a fascinating rule. Why?
It's pure risk management. His rationale is that if his account is progressing significantly, the market is likely becoming more extended. It's more vulnerable to a correction. Increasing your size late in the market cycle just multiplies the cost of that inevitable correction. It's an anticipatory de-risking strategy.
That's a brilliant insight into market cyclicality, and Ritchie II approaches this from the perspective of drawdown risk.
Yes, he only increases his size after earning a significantly larger portion than his average historical percentage drawdown. So if his average drawdown is 15%, he needs his current account buffer to be way more than 15% before he ramps up his risk.
It ensures the new size is only taken on when the equity buffer can comfortably absorb a typical historical loss.
Exactly.
So since they concentrate capital, they must be able to judge the quality of a setup. How do they quantify which stock deserves that maximum 25% allocation?
Minervini and Ryan, they prioritize stability. They look for volatility contraction and a low-risk entry point. They're seeking the stock that looks the tightest and quietest right before the move.
But Zanger, the volatility king, has a slightly different emphasis.
He does. His primary factor is volatility combined with a solid base, the length of the base, whether it's a first or second stage base. He explicitly states that stocks that can make large intraday moves qualify for more capital. For him, bigger potential move equals more devoted money.
So he's chasing explosive velocity, where Minervini is chasing low-risk precision.
That's a good way to put it. And then Ritchie II adds a human element. He calls quantifying setup quality an art.
An art.
He breaks it down into a hierarchy of conviction. He looks at technicals first, then fundamentals, then the group. The most capital goes into the ideas with the highest conviction, which is a calculation that's heavily influenced not just by the setup, but by his recent trading results, his overall market exposure, and critically, the stock's liquidity, the ability to get out quickly.
Okay, let's move to the action itself. Technical analysis and timing signals. This is the moment they pull the trigger.
For Minervini, the ultimate buy signal is defined by the volatility contraction pattern, or VCP. This is the core engine of his entire system.
The VCP is often discussed, but let's be explicit. What is it, and why does it matter so much to momentum trading?
A VCP is a clear, repeatable pattern where a stock's price volatility tightens up. It moves in a series of smaller and smaller ranges like a coil spring compressing. And this contraction, it must be accompanied by a dry up in volume.
A selling vacuum, he calls it.
A selling vacuum. The combination indicates that all the supply, all the sellers, have been exhausted, and the stock is now ready to accelerate through a pivot point on renewed institutional demand.
Why is the dry up in volume more important than the price contraction itself?
Because the volume dry up confirms that the lack of movement isn't just hesitation, it's an actual vacuum of supply. If volume remains high while the price is tightening, it means there are still heavy sellers fighting the stock. The base is more likely to fail. The selling vacuum confirms that the stock has carved out the line of least resistance.
So the upside birth is much cleaner. It's the silence before the storm, basically.
Exactly. Ryan seeks similar conditions. He looks for very stable price action, a week or more of very quiet, tight movement after a larger base is formed, and the stock is in the upper half of its chart pattern. It's all about stability preceding acceleration.
And underpinning all of this is the concept of a proven uptrend. Minervini stresses never going long, a stock that's trading below its declining 200-day moving average.
That 200-day is their market compass. Ritchie II expands on this, stating he won't even consider a stock unless it's trading above its 200 150, or 50-day moving average, showing increasing strength over multiple time horizons.
Zanger defines it visually as stair-stepping higher.
Right, with a series of higher highs and higher lows, with solid, tight bases in between. It just reinforces that they're all looking for established, unmistakable institutional interest before they ever join the trade.
Since they're looking for such explosive moves, do they prioritize fundamentals like earnings or technicals?
While the momentum approach respects fundamentals, they always prefer stocks with strong sales and earnings growth. The chart takes precedence. Minervini is willing to trade stocks with a lack of apparent fundamentals when the chart is really strong.
He calls that unexplained strength, so he'll trade a stock even if the fundamental story isn't clear yet.
He will, because that situation often results in the best risk-reward plays. If the strength is unexplained, it means the trade is less obvious and therefore not crowded. Price action is the leading indicator. Minervini recognizes that in a highly speculative bullish market, you follow the money, even if the research report hasn't caught up yet.
This leads to the distinction between a fundamental leader and a price leader.
Precisely. A stock with poor current fundamentals but excellent relative strength near a 52-week high still qualifies as a price leader for Minervini and Ritchie II. This aligns with the fact that the market often moves up 6 to 9 months in advance of good economic news or spectacular earnings reports. Technicals are their early warning system. They tell you where the smart money is moving now.
Breakout or pullback, which is the preferred buying strategy. Does the Minervini system favor one over the other?
Ryan points out that the preference depends entirely on the market environment. In a tough, choppy market, breakouts tend to fail as institutions fade the enthusiasm, so he buys more pullbacks.
But in a strong, powerful uptrend.
In a strong uptrend, breakouts are definitely preferred, because waiting for a pullback risks missing a huge percentage of the move.
Minervini buys whichever offers a low-risk setup, prioritizing the cycle's technical theme.
And he notes that most of his pullback buys are actually entered while the stock is still in a base before the breakout even happens. He's positioning himself defensively.
And a breakout itself is defined by Ryan as a stock emerging out of a base or consolidation that's at least 4 weeks long.
Right. They want a long enough consolidation to ensure all the weak hands have been shaken out.
And the volume requirements are strict and quantified. Volume must confirm the move.
Minervini likes to see volume eclipse its own 50-day average. More volume is always better. Ryan wants volume up at least 25%, but he's really looking for that institutional conviction, which is evidenced by 100% to 200% increases in volume on the breakout day.
That huge volume spike is the market confirming that the institutional cruise ship is turning.
Exactly. Zanger requires a volume surge greater than 50% of the 20-day or 30-day average. The quantitative nature of these rules is non-negotiable for identifying a sustained move.
This brings us to execution, which is often where theory meets painful reality. Do they wait for confirmation at the close of the day, or do they act intraday?
The consensus is firm. You buy intraday once the pivot point is breached. Minervini typically buys just a few pennies to 30 cents above the buy point.
Why the urgency? But isn't it safer to wait for the closing confirmation?
Zanger explains that waiting for volume confirmation at the close risks missing the move entirely because the stock might be too extended. If you wait for the stock to close $10 above the pivot point, you've missed the low-risk entry, and your stop loss, which is calculated off that original pivot, is now dangerously far away. You're forced to risk too much capital.
So they buy on price action and hope the volume confirms. They're effectively leading the confirmation rather than waiting for it.
That's right. Minervini and Ritchie II buy on the initial price action. If the volume doesn't progress throughout the day, or if things reverse, they just sell. This mitigates the risk of missing that initial, powerful, low-risk move.
And Minervini even uses volume extrapolation.
He does. If a stock that normally trades 500K shares a day has already traded 175K by 10:30 a.m., he knows it's on pace for 1 million shares, and he'll buy on that extrapolated conviction.
What if the stock immediately pulls back to the breakout area, effectively testing that pivot point?
Minervini and Ritchie II are both patient with this. They see it as normal action. Minervini notes that pulling back to the breakout area or slightly undercutting it is common. It happens about half the time. As long as the initial predefined stop holds, he stays with the trade. He'll often move the stop to break even once a decent profit has been attained, protecting his capital and minimizing risk.
We have covered the rigorous entry mechanics, the philosophy that sustains multi-decade success, and the absolute discipline required to achieve those astronomical returns. Looking across these 4 sections, you see a unified methodology, even if the application differs.
The core principles shared by the masters are absolutely unmistakable. The focus on price action and technicals overriding stories, the non-negotiable need for extreme concentration, the discipline of small, calculated risk, and the importance of VCP and volume dry-up in timing your trades.
If we connect this to the bigger picture, what stands out most clearly is the high degree of similarity in risk management, despite the significant differences in their selection focus.
Yes. They can disagree on small cap versus large cap, or the optimal timing for a breakout versus a pullback, but they are religious about their stops.
Absolutely.
They are. Minervini and Ryan embrace the inefficiency and explosive potential of thinly traded small caps. Zanger leans toward the robust liquidity of larger mega caps. Yet, they all share a profound commitment to cutting losses quickly, often within 5%, and letting success, backed by a mathematical edge, dictate their exposure size. They scale into winners and scale out of losers instantly.
That consistency in risk management, it raises an important question for you, the learner. Is high-risk, high-reward trading truly accessible to everyone, or does it require Zanger's 25 years of devotion to charting and Minervini's 6 years of painful trial and error to confidently identify the setup quality that justifies such intense concentration?
The answer they provide is, it's a commitment. It requires the same level of discipline and dedication you'd give to a demanding career or a marriage, sticking to your defined strategy, even when it inevitably underperforms for a period. The massive returns are the reward for that intense commitment to the process, not the outcome of luck.
We spend a lot of time on the mechanical aspects of entry, position sizing, and timing. But let's return to the philosophical turning point. For you, the learner, consider that psychological shift Minervini described, the moment everything clicked for him after 6 years of failure. Realizing that the goal is not to be right, but to make money.
That is the ultimate challenge. Divorcing yourself from your opinion, your ego, and your stories, and letting the cold, hard numbers, price, and volume be your only guide. That single, severe ego check fundamentally changes your approach to cutting losses. It makes those low-percentage, high-risk trades sustainable over the long term.
Thank you for joining us for this deep dive into the high-performance trading strategies of the Momentum Masters.
We hope these nuggets of knowledge give you the rigorous insights you need for your own journey to greater returns with less risk, reminding you that mastery begins with discipline.
Welcome back to the deep dive. We are absolutely thrilled to come back to continue Momentum Masters and pick up where we left off with that incredible Super Trader Roundtable.
Yeah, with Mark Minervini, David Ryan, Dan Zanger, and Mark Ritchie II.
Exactly. Last time we really focused on, how they find these stocks. But now we're shifting gears. We got so many great questions from you about the real nuts and bolts.
The mechanics.
Mechanics of trading, risk control, and I think most importantly, the huge psychological hurdles. And that is exactly where we're headed today.
It is. Today, our mission is really to synthesize that final, most tactical half of their discussion. We're covering everything from, how they link company health to the charts, to defining those super precise entry points.
Those are really tough stuff.
The really tough stuff. The rigorous philosophy of managing your capital and, maybe even more critically, managing yourself. This is where they spill the beans on how they handle exposure, execute under pressure, and set those ironclad risk rules.
We're trying to slice through all the theory and get straight into the applied knowledge. We want to understand the fundamental principles that take their trading from just, smart investing to a genuine high-performance system.
And give you that actionable context on what really drives those huge stock moves.
And, critically, how to avoid the biggest psychological traps that take out even really talented traders.
Okay, let's unpack this and start right at the foundation. How do they actually connect the company's health with the chart action?
Well, the first thing you have to grasp is what they call the technical fundamental sequence. And honestly, it might flip the script for a lot of listeners who come from a more traditional fundamental background.
Okay, how so?
Minervini and Ryan are completely unanimous on this. They look at the chart, the long-term trend first. The chart is the ultimate timing filter.
So price behavior is the first screen. They're not digging through balance sheets and then looking for a chart that fits. Not at all. They're not trying to catch a falling knife just because, the PE ratio looks cheap. Minervini says it explicitly. He will not buy a stock in a long-term downtrend, period.
Regardless of the story.
It doesn't matter how stellar the fundamentals or the valuation might seem. His logic is, if the market isn't confirming that positive news with a rising price, well, You're missing a key ingredient. Or you're just early.
Which, in trading, is often the same as being wrong.
Exactly the same.
Okay, so that brings up a great question. If the technicals give you the setup and the when that optimal low-risk entry, what's the actual point of the fundamentals in their process?
Ryan clarifies this just beautifully. He says, strong fundamentals provide the confidence you need to hold a stock through all the inevitable volatility and the shakeouts that happen during a big multi-quarter move.
Right.
The chart gets you in the door, but it's the accelerating sales and earnings that are the fuel. That's what lets you sit through a 10% pullback, knowing the company is solid and probably poised for much higher prices.
So if you have two charts that look identical,
you always choose the one with the better fundamentals. You're just maximizing your probability of holding on long enough for it to become a real super performer.
it's the difference between a quick trade and a real position. Okay,
Yeah.
so let's talk about that fuel. Minervini says something really powerful. He calls it a fact, not a belief, that the same things move stocks today as they did decades ago. What is this timeless engine?
It's that dynamic between supply and demand, and it's driven by one thing. Sustained, high-quality, sales-driven earnings.
Sales-driven, that's a key distinction.
It's critical. He brings up examples like Coca-Cola in the 1930s or Walmart in the 80s. I mean, we think of them as giants now, but they were once small, high-growth companies.
Right.
And they were generating massive earnings that were supported directly by huge top-line revenue growth, sales growth. They had incredible earnings and perfect chart patterns. The principle hasn't changed. Big moves are always driven by companies making more money, which attracts that big institutional money flow.
The big money only chases real growth. So how do they quantify that momentum on the income statement? It's not just high growth, is it? It's acceleration.
It is, precisely. They are relentless about focusing on acceleration and sequential growth. Minervini specifically looks for year-over-year quarterly earnings that are accelerating sequentially.
So getting faster.
Yes, over the most recent 1 to 4 quarters. He wants proof the business is speeding up. He also looks for earnings that suddenly break out of a multi-year range. He calls that a breakout year.
Okay, so let's break that down with an example. It's not just a flat, say, 30% growth year over year. It's more like quarter 1 was up 15%, quarter 2 is up 25%, and then quarter 3 just glue it out at 40%.
That's the sweet spot, that escalating trend.
Yeah.
And Zanger backs this up. He's looking for gains of 30, 40% or more, and he wants each quarterly percentage change to be bigger than the last quarter and bigger than the same quarter a year ago.
Wow, so triple check on its strength.
Exactly.
But Minervini has a really crucial warning about sales that I think is easy to miss.
Yes, and this is so vital for understanding what high-quality growth actually is. Earnings growth that's paired with negative sales. It has a very limited shelf life.
Because it's just cost-cutting.
It's just cost-cutting. Productivity enhancements, layoffs, efficiency gains, you can only do that for so long. Eventually, you run out of fat to trim. For sustainable earnings momentum, you have to have top-line growth. You need sales. That's the sign of real business expansion.
And the big institutions know this.
They know it, and they will dump a stock in a heartbeat if they see it's only growing earnings by cutting costs.
This leads us right into the PE paradox. Momentum stocks are often high PE, which scares a lot of people off. But Minervini actually says he prefers a relatively high PE. Why would he shun a cheap stock?
Because in this world, a low PE is often a major red flag. It suggests something is fundamentally wrong with the business. The market is pricing it cheaply for a reason.
Nobody wants it.
Right. On the other hand, a relatively high PE, that indicates demand. It suggests something really positive is happening, and the market is willing to pay a premium for that growth.
But doesn't that carry huge risk? I mean, if a company misses by even a penny, the stock can get crushed.
It absolutely does. And he warns that high PE stocks come with almost zero room for error. You have to be ready to act incredibly fast if things turn, because the punishment from the market will be merciless.
So the risk is managed not by avoiding the stock,
but by using incredibly tight stops, which we're definitely going to get into. They choose high potential, high velocity, and they just accept the higher risk of a sharp drop if their thesis gets proven wrong.
Okay, let's pull back to the macro picture. Why do they focus so intensely on individual stocks instead of just trading, say, the QQQ? Isn't the market tide the most important thing?
It is, but the focus stays on stocks because that's where the real leverage is. Minervini points out that the leading stocks can move 5 to 10 times the return of the NASDAQ index in the same amount of time.
Wow.
So if the index is up 10%, a leader might be up 50% or even 100%. Why would you settle for the average return when you can isolate the true outliers? They're hunting for alpha, and you find alpha in sector leaders, not the benchmark.
So, does the overall market trend dictate all of their decisions? Are they trying to time every little swing in the S&P 500?
They use it more like a guide, a risk barometer. I like to think of it as a compass, not a steering wheel. Minervini has a market risk model, but his main focus is always on the stocks. If his model is bullish, but he can't find any stocks setting up properly,
The model doesn't matter.
it's irrelevant. He just stays in cash.
And Ryan cautions against letting the market make you too bearish or bullish. That sounds a little counterintuitive.
It really speaks to discipline. If your market indicators are flashing a sell signal, but your individual stocks are holding up strong, holding their support levels, you don't just liquidate everything.
You don't throw the baby out with the bathwater.
That's his exact phrase.
Mhm.
Sometimes the index is getting dragged down by a few huge sectors, but your stocks are in a totally different area that's still strong. You have to follow the signal of the capital you actually have deployed.
So if the index is falling, but he's not selling based on that, how does Minervini know when to sell?
He lets the stock itself tell him. He lets the stock signpost the sale. That happens one of two ways. Either it hits his hard, predetermined stop loss, or if he has a nice profit, he'll use a backstop, like a trailing stop to lock in most of it. The action is always dictated by the stock's own behavior, not by fear from watching the S&P 500.
What about the opposite situation? A stock chart looks amazing, but the general market is clearly in a bear market. Do they still step up and buy?
This is where caution becomes everything. Generally, no. They're on the sidelines or they're trading much, much lighter. A bear market just kills the probability of any stock making a sustained move.
And Zanger is pretty extreme on this.
He is. He says he avoids stocks 90% of the time when the market's in a downtrend. He knows that in a hostile environment, even the best-looking setups tend to fail. He'll only step in during these little modest 2-3% dips that look like normal corrections inside an otherwise healthy uptrend.
And Ritchie II adds another layer of confirmation here. He wants to see a variety of stocks bucking the trend. Why does variety matter so much?
It's that institutional money flow signal again. A falling market isn't an automatic no, but he needs to see a whole group of attractive stocks setting up, not just one isolated leader.
Because one could be a fluke.
Could be a fluke, could be an anomaly. But if you see a whole handful of stocks in different industries all showing strength, that signals that big institutional money is rotating into new areas despite the overall weakness. That variety gives you the confidence that the strength is real.
That's a great risk gauge. So if they're trading small and rough patches, what's the signal for them to get aggressive and really step on the gas?
It's so simple and pragmatic, it's brilliant. The answer is success and traction.
So results.
Just results. They don't ramp up because they have a feeling. Minervini's gauge is just this. If his first small pilot buys show immediate gains, he gets more aggressive. It's core to their whole method. It guarantees he's trading his largest when he's trading his best and his smallest when he's trading his worst.
Okay, so if success dictates the size, let's get into the nitty-gritty of execution. For traders moving real size, liquidity is a big deal. How do they actually start a position? Scaling in or all at once?
Scaling in is pretty typical, it has to be, for liquidity, but it's also a great risk management tool. Minervini might buy a tiny pilot position or maybe start the day with a 5% position, but he only ramps up to his full 10% size if the stock closes strong in the last 15-30 minutes of the trading day.
Ah, so he's using the end-of-day action as a final confirmation.
It's the final filter before he commits all the capital. Zanger does it too. If a stock gaps up on huge earnings, he might buy a piece if it's still within 5% of its base and then add more the next day if he sees strong follow-through. They never commit 100% of the capital instantly.
Ritchie II had a fascinating point about the emotional side of that first entry, that fear of missing out versus the fear of being wrong. How does he handle that moment of commitment?
He says that coming out of cash is the moment of highest risk and highest opportunity. It's the highest stakes moment. So he uses a toe-in-the-water mentality. That small initial size is critical.
Why?
Because if those first few positions work immediately, if the market confirms his timing, then he gets aggressive, and he gets aggressive fast. His whole philosophy is let the market dictate your exposure. If it confirms your thesis, you press. If it doesn't, you pull back.
Let's define that entry point even more precisely. We know they buy breakouts, but how far above the pivot point do they actually buy? Are they just putting an order 1 cent above the high?
Almost never, especially not Minervini. He's usually buying intraday, maybe 5, 10, or even 20 to 30 cents above the pivot. He very rarely buys just a penny above.
Why the buffer? What's wrong with buying at 1 cent above?
That 1 cent level is just too vulnerable to noise. Brief volatility, maybe even stop hunting. If every retail trader puts their order right at the obvious technical level, it's easy for market makers to just push the price past that point for a second to trigger all those orders. By buying 10 or 20 cents above, he's giving the trade a little cushion to absorb that noise.
And Ryan, he's a bit tighter, isn't he?
He is. He buys 1 cent above, but he couples that with a really important rule. He starts small intraday, and you will not buy the rest of his position unless the stock closes strong in the upper half of its daily range. It's all about confirming that buying interest.
This brings up the big strategy debate. Buying a pullback versus buying a breakout. Is there consensus?
The consensus is definitely to prefer the breakout. The best stocks often just rip higher and never give you a pullback. But they do use pullbacks as a secondary strategy with very strict rules.
Such as?
Minervini, for example, will buy a pullback to the 20-day or 50-day moving average, but only the first or second time after a major breakout. And the number one rule.
Let me guess. Don't catch a falling knife.
You never, ever buy the falling knife. You have to wait and buy as the stock turns up. Never while it's still falling. You wait for the bounce to confirm support.
Ritchie II is big on this too, right?
Huge. He says he will not blindly put a limit order at the moving average. He waits to see how the stock acts, and he buys after it's bounced. That way he avoids those situations where the moving average just fails completely.
And what about stocks that gap up on earnings? If it opens way past the buy point, is it too late?
Generally, yeah. Minervini doesn't chase if it gaps more than a few percent past the pivot.
Yeah.
The risk-reward is just destroyed at that point. He's looking for what he calls a buyable gap on earnings, where it's still close enough to the base that he can get in with a manageable stop.
Now we get to the topic that really separates the pros from the amateurs. Risk management. The insurance policy. How do they even decide where to put their stop? Where they admit they're wrong?
The criteria vary a bit, but they are all rigidly defined. Minervini will use a technical level, like a prior swing low, if the risk percentage is okay. Or he'll just use a fixed percentage, like 5–7%, in a really volatile stock. And sometimes he works backward from a dollar amount.
What do you mean?
He'll decide, I'm only willing to risk $1,000 on this trade. If his stop needs to be $5 below his entry, well, the math is simple. He can only buy 200 shares. The risk dictates the position size.
And Zanger is more chart-focused.
Yeah, he relies on things like rising trend lines or fast-moving averages, like the 10-day or 21-day. If the trend line breaks, that's his signal. The character of the stock has changed.
Ritchie II has a really fascinating metric-driven approach to this.
It's amazing. He calculates his stop placement based on his own historical trading metrics. He knows his win-loss ratio, his average gain, his average loss. He knows that when he's buying correctly, the charts usually break down somewhere between 3% and 10% below his entry. So his stop is calculated to preserve his system's statistical edge.
Let's talk about the geometry of loss. Minervini and Ryan both say they prefer smaller losses. So is it better to take one 10% loss or two 5% losses?
Two 5% losses every time. And the reasoning is purely mathematical. A 10% loss requires an 11.1% gain just to get back to even.
Which doesn't sound too bad.
It doesn't, but it gets out of hand fast. A 20% loss needs a 25% gain to recover. A 50% loss. You need a 100% gain. You have to double your money just to get back to where you started. Bigger losses work against you geometrically.
So by taking two 5% losses, they're giving themselves two shots at getting the timing right, and they're still only down 10%. They haven't crippled their account.
Or their confidence. That's a huge part of it. Minervini calls 10% his uncle point the absolute max. But he'd much rather focus on timing precision, which tight stops force you to do, than spend all his energy trying to dig out of a massive hole.
Okay, moment of truth. The stock hits your stop, but it's on really, really low volume. Do you give it a little more room?
No. Unanimous, ironclad rule. If the price hits the stop, you are out. The volume is completely irrelevant. Ryan warns that this is where rationalization begins. Oh, the volume is light, it'll bounce back. That's how small losses turn into catastrophic ones.
One of the biggest risks is the overnight gap. How do you manage the risk of news breaking overnight and the stock opening way, way below your stop?
You can't eliminate it. Minervini says you can only mitigate it, and you do that with position sizing. If he's in a stock that's known for being a serial gapper, he just sizes the position much smaller to account for that extra risk.
And his advice is brilliant. Sell down to the sleeping point.
It's the ultimate risk tolerance test. Can you sleep at night? If you're lying awake worried about your position, your size is too big, period. You have to be able to execute your plan rationally, not out of anxiety.
What about stop hunting? Is it real? Should traders use mental stops?
Ritchie II is very candid about this. He believes the current market structure absolutely makes resting stop orders a target, especially in less liquid small and mid-cap stocks. He advises against placing stops too close or at really obvious levels.
But a mental stop,
Hmm.
just deciding in your head where you'll sell, that sounds like a disaster waiting to happen for most people.
It's a recipe for ruin for anyone who isn't incredibly disciplined. Ritchie is adamant. Mental stops should only be used by disciplined professionals. If you have ever struggled to hit the sell button when you know you should, you must use a physical stop. You can't rely on willpower in the heat of the moment.
Let's play out the worst case scenario. You buy at $20, your stop is at $19. Bad news hits and it gaps down to $15 at the open. What do you do?
Sell. Plain and simple. Minervini and Ritchie both say it. You sell immediately. You have to take the loss and move on. You cannot fall into the emotional trap of hoping it will bounce back. That's where you can destroy an account. Zanger has a slight tactical tweak. He might wait for the first wave of dip buyers to push it up $1 or $2 from the low, and then he sells the whole thing. But the imperative is the same. Get out. As he says, move on, it doesn't love you anymore.
Okay, we've covered cutting losers, but the real money is made by managing winners. How long do they typically hold a stock?
Minervini says winners are held 2 to 3 times longer than losers, usually for 2 to 3/4, but rarely for years. He says the most explosive part of a move happens in the first 12 to 24 months.
Zanger's similar, a few months, right?
Yeah, typically a few months, and he'll use the break of the 21-day or 50-day moving average as his final sell signal. It gives the stock enough room to breathe through normal corrections.
The big psychological battle for every trader is that conflict. Do I take profits now, or do I let it run for a monster gain? How did they handle that?
Minervini has this great sell half rule. It's a psychological win-win. If a stock moves up quickly, he'll sell half and immediately move his stop on the remaining half to his break-even price. So he's now free-rolling the second half.
That's genius. You've locked in a profit, the pressure is totally off, and the rest can run without the risk of turning a great trade into a losing one.
Exactly. It removes regret. If it skyrockets, you're still in. If it collapses back to where you bought it, you still made money on half the position.
And Ritchie has a specific metric for this, tied to his risk management.
He does. He's relentless about making sure his winners are big enough relative to his losses to keep his system profitable.
Yeah.
He says he will never sell a stock into strength that isn't at least twice his original risk amount.
So if his stop was 5% down,
he won't even think about touching it until it's up at least 10%. This ensures that even if he's only right half the time, his winners are so much larger than his losers that he makes good money overall.
what if a stock just explodes, up 20% or more in just a few days? That seems almost too good to be true.
They see those as the true leaders, the ones you have to give extra room. Minervini might sell a small piece just to bank something, but Ryan says he just continues to hold them, believing they're on their way to a huge move. Zanger has the most structured approach. He reduces his position at the 20% profit mark, locks it in, and lets the rest ride.
When do they adjust their stops to protect those profits? Do they move it to break even as soon as they're up a little?
No, that's a classic mistake. Minervini says he never moves his stop to break even until the price is advanced by a multiple of his original risk, or it's above his historical average gain. If you move it too tight too soon, you'll just get shaken out of a big winner on normal volatility.
But his one cardinal rule.
He will never let a big gain turn into a loss.
And Ritchie II has a similar philosophy.
Very similar. He moves his stop to break even once the stock is past his average winning trade. If his average winner is 15%, once the stock hits that, the stop comes up to his entry price. It just reinforces that idea. A better than average winner should never cost you money.
Last question on this. What makes them sell before the stop is hit?
If the stock violates their internal rules, or if they just realize they made a mistake in their analysis. Minervini calls them violations. Maybe the volume looks wrong, or it fails to follow through after good news.
And Ryan had a great insight on this about professional ego.
He did. He says, holding on when you know you've made a mistake is just fighting the market, and that's how you get serious losses. He mentioned that sometimes doctors make bad investors because, in their job, admitting a mistake can be catastrophic. In trading, admitting an error quickly is mandatory for survival.
The mechanics are one thing, but the mindset is everything. How do they maintain discipline and fight that constant urge to overtrade?
Ritchie II has a very practical, data-driven solution. He just watches his recent results. If things are going well, keep trading, be aggressive. If his trades are choppy and he's taking small losses, he gets more selective or cuts his size way back. It turns discipline into an objective decision, not a battle of willpower.
That approach seems like it would help with analysis paralysis, too, that fear of pulling the trigger.
It does. Minervini's advice for that is to just trade small until you're comfortable. Big losses crush your confidence, and that creates a negative feedback loop. Zanger says you have to set your line in the sand before you enter and then stick to it no matter what.
And Ritchie's no-brainer approach is designed specifically for this.
It is. He says every trader needs a set of conditions, your perfect A-plus setup, that when they appear, you are compelled to take at least a small position. Success on those builds the confidence you need. You finance your next risk with your prior wins.
When a trader hits a losing streak, a drawdown, what's the first tactical adjustment they make?
Minervini and Ryan are identical on this. Trade smaller. A string of losses usually means the market conditions are hostile or you're just out of sync. Trading smaller protects your capital while you wait for things to improve or for you to recalibrate.
How have they avoided style drift? Jumping from momentum to value just because the market changes.
Minervini compares it to a marriage. He says partial commitment leads to poor results. You have to be all in on your system. But Zanger makes a crucial distinction here between strategy and tactics.
Okay, what's the difference?
The strategy buying high-growth leaders, that's constant. But the tactics have to adapt to the market. So if the market gets choppy, a tactical adjustment means cutting your margin, reducing position size, holding more cash, maybe using tighter stops. The philosophy is the same, but the execution changes based on the environment.
Looking back on their journeys, what were the hardest obstacles for them to overcome?
For Minervini, it was two things. First, maintaining religious discipline, stopping those just this one-time moments. Second, practicing patience, developing what he calls sit-out power to avoid forcing bad trades. Zanger's was learning to cash out before a big market break.
And what about the big aha moment that changed everything?
For Ritchie II, it was realizing the incredible power of compounding a good idea. But that only works if you successfully manage the downside. The upside takes care of itself if the downside is protected.
Let's run through a few of their top rules as a final checklist.
Zanger. Never let a good gain turn into a loss. Never chase a stock more than 3–5% above its pivot, and reduce size after a big move up. Ritchie. Always trade with a plan, always reduce size after a big loss, and guard your emotions as carefully as you guard your capital.
And why does Minervini think the average investor fails?
He lists 7 reasons, and they are all behavioral. Poor stock selection, not cutting losses, that's the most common mistake, and adding to losers, which he calls the #1 reason traders blow up. Ritchie just boils it down to 2 things: a lack of knowledge, and more importantly, a lack of discipline. He says discipline gets the job done.
So what's their final advice for a new trader starting out?
Minervini says get a role model, learn from your mistakes, and understand that any plan with firm risk rules is better than no plan at all.
And Ritchie II has his 3 mins.
Yes. Success only happens when you get these 3 things right: the market, the macro environment, a proven method, your strategy, and myself, your psychology and risk management. And they all agree that the self is by far the hardest part to master.
What an extensive deep dive this has been. I mean, we've gone from the earnings that light the fire under a stock all the way to the ironclad rules you need to protect your capital and your confidence. The consistent message from all 4 of them is that success really just comes down to preparation, sticking to your rules and managing your own mind.
It really is. And if we connect this to the bigger picture, what they're all saying is that market principles, supply and demand, they're timeless. The one variable that's always changing and the only thing you can actually control is yourself. And that raises a really important question for you to think about. Based on everything they said about mistakes and drawdowns, what is the one common denominator in your own recent trading results that you should focus on analyzing and fixing right now? That post-analysis is really the first step.
We hope this look into the strategies of Minervini, Ryan, Zanger, and Ritchie II gives you plenty to chew on. If you found this deep dive valuable, thank you for watching. Please like, share, subscribe, follow up in next video. We really appreciate you joining us on this journey to becoming well-informed.